Um, I'm more than happy to be interrupted during the talk. For the sake of any Zoom participants we may have, I'll repeat questions if I get them along the way. The work is joined with Natalia Kovrijnykh, who is at Arizona State, Yuri's colleague, and Ariel Zetlin-Jones, who's at Carnegie Mellon. I'm at the Philly Fed, so I do have to say that these views are ours and not necessarily those of the Federal Reserve Bank of Philadelphia or the Federal Reserve System. And let's get into it. So what we're going to be talking about is very early stages of credit life cycle. So ultimately, the topic of the conversation is access to credit. I understand that in a world where some people have trouble accessing their own checking accounts, accessing credit might seem like a second-order issue. It is a little bit of a first-world problem, but I'm going to proceed under assumption that it is an important first-world problem. Because accessing credit may be important for ability of households to smooth income shocks, smooth expense shocks, smooth intertemporally. Buying a house typically requires a mortgage in most countries. So I'm going to take for granted that access to credit is important for borrowers, and what I'm going to focus on is the very early stage of building this access to credit. Now, I have a lot of experience in this because I had to build my credit history in North America 3 times. When I first moved there for graduate school, then I moved to Canada, and I had to start from scratch. And then 5 years ago, I moved back to the States, and I had to start from scratch again. It's been a lot of fun, because every time you get this rejection letter from a credit card company going, "Nah, your credit history is too short." Like, well, that's a little bit of a catch-22. You can't build credit history if you don't have a credit card. And you can't get a credit card if you don't have a credit history. So this is kind of, that is what we're going to talk about. So basically, the normal view of credit history in the literature is, well, the credit history is history of repayment of loans. What we want to emphasize, what we think is very important at the very early stage, what I personally think is very important at the early stage, is even the fact that somebody else gives you a loan may be informative. So we're going to focus on this other aspect of credit history, which is history of borrowing per se. All right? Now, yep, that's it. What we're going to do is we're going to start with showing some very basic facts. So we got a new data set, which is really cool. And we're going to document some facts that are not surprising and some facts which we find very surprising and motivate exactly what we're... Again, we came from it from personal perspective, but turns out that holds up in the data more generally. And what we're going to document is that lenders, when it comes to very new borrowers, lenders seem to actually react positively to a borrower taking on another product, another credit card. It's not the case for established borrowers, but when it comes to new borrowers, somebody else giving you a loan is a good signal to lenders, which kind of goes against the traditional view of debt dilution, which is if somebody else gives you a loan, that's bad news, because you're now more likely to default than me. So when it comes to emerging borrowers, we're going to document these new facts. And then we're going to interpret these facts that we're going to document as there is some what we call information aggregation across lenders. Some lenders know something about you that other lenders don't. And you taking on a loan conveys their information to other lenders. We're going to write down the most basic theory the most basic model we possibly can to capture this story. That most basic model is going to be it's going to be very stripped down, but still annoyingly complicated in a way. But we're going to learn a few things from the model, and the model is actually going to give us some testable implications that are not obvious ex ante. We're going to take those to the data, and turns out the data is going to support those, again, for emerging borrowers. So let's get into what emerging borrowers are and what the data are that we're using. So, as I said, we kind of started from this personal experience, and actually, let me be honest, we started with the model. We rolled down this model, we started presenting it. People said, "There's no way that's in the data." I'm like, okay, let's go by the data. This was before I joined the Philly Fed, so we didn't use the Fed data, the consumer credit panel that's available at the Federal Reserve. We went and bought the data from TransUnion, which is one of the 3 major credit reporting agencies. So it's custom-made data set, where the key thing is we asked TransUnion to give us 500,000 people who are new to the credit market. More specifically, their oldest credit trade is no more than 6 months old when we first see them in September 2014. So that's our study sample. Those are people we're going to call emerging borrowers. And then to have a control sample, we have another 500,000 people who are just representative population of everybody else. So they're taken to represent the credit score distribution in the country. We see them 4 times, every time in September, 2014, 2015, 2016, 2017. So we're basically just going to track them over those years. The key thing about the data is we're able to keep track of individual credit cards. It's not aggregated to a portfolio, it's literally we can track individual cards. So we'll be able to talk about responses of lenders to news about the borrowers. All right. So, what are some basic facts? If you see all those buttons, I can tell you a lot more, ask me. But what are the basic facts that I'm going to take as motivating evidence? Let's go with 4. First, emerging borrowers' credit limits grow a lot more than those of established borrowers. Duh. These people are new to the credit market, they're growing. I mean, they start from a very low base. They don't catch up in 4 years. There's still plenty of room to grow. So that's really not surprising. Second fact is even less surprising. People who open a new card have their credit limit expand more than people who don't open a new card. Duh. Let's get to the interesting part. People who get a new card, a very large chunk of their growth in credit limit comes not from the new card, but from their existing card. Of the 200, so let's focus on the emerging for a second. People who get a new card had tripled their credit limit. Great. But the credit limit on their existing card more than doubled. So 2/3 of the growth in their credit limit came not from the new card, but from their existing card. And that's fact number 3. Fact number 4, that is much less of a case with established borrowers. So established borrowers who got a new card saw a 31% rise in credit limit. Only 5% of that, only 5 percentage points of that came from the existing card. So, in fact, let me kind of flesh that out a lot more. Let's look specifically. So what we're already getting at is existing lenders seem to take it as good news when emerging borrowers get a new card. Let's time it. This is kind of almost an event study type thing. This graph, I am now restricting the population only to those who got a new card. Some of them, so I see people only in September. We didn't have enough money to buy a full panel, but we can still do this. I see first, the first time I see people is September 2014. I'm going to now look at September 2015, and I'm going to say, okay, some of these people have already got a new card. I also see them in 2016, so I also know that some of these people will get a new card shortly thereafter. So that's how basically breaking things down. These are people who got a new card exactly in September, in August, in July, in June, and so on. So this is months since they got a new card. To the left of the dashed line, these are people who haven't yet got a new card, but they will in the coming months. So what we're trying to get at here is there's a very discrete jump. Sorry, and what we're plotting is the change in percentage points in the incumbent, in the existing card's credit limit. So existing lender, the lender you had back in 2014, they discontinuously increase the credit limit the minute you get a new card, long before you had any time to establish repayment history on it. So when it comes to, and sorry, the blue points are emerging borrowers, gray points are established borrowers. There is some action for established as well. It's not nearly as big as for emerging. So for emerging borrowers, if a lender sees you get a new card, they go, oh, somebody else has something good to say about you. Somebody else is willing to give you a loan. That's good news. All right? So that's my motivating evidence. I'm happy to talk more about what it's not about. So there are other potential explanations besides this information aggregation. We try to control for those. You didn't ask me about them. You'll have your chance later, maybe. So what am I going to take away from this? I'm going to say, hey, I think I see evidence of information aggregation. I think I see evidence that when a lender, let's give some lenders some names. Leva's going to be my lender. Not in person. You're just, oh wait, I need two lenders. Who's my second lender? Alex is giggling, so he's my second lender. You want to be my lender? No.
Clarifying question. On the previous graph, the emerging borrowers, before they got the card, so what are those? If they don't have a card yet, what is the...
Right. So the entire sample, sorry, the question was, emerging borrowers in this graph who haven't got a new card, what's happening there? So let me walk a little bit more slowly through this. Emerging borrowers are people who in 2014, the first time we saw them, their oldest credit product, let's call it credit card, was no more than 6 months old. So I label you emerging once when we first get our data, so 2014. This is based on 2015 September. So in 2015, so what I want to, I only see the credit limits on the cards, not every month. I know when you open the card month by month because of the nature of the data. I don't see the credit limits month by month. So the way I'm going to do this exercise is I'm going to go in September 2015 and look at those emerging borrowers, sorry, those borrowers who were emerging in 2014. They had a credit card in 2014. That's a part of the selection, sample selection. And I'm going to say, what happened to the credit limit on that old card? On that new card. On the card they had in 2014, their first credit product. Now, I want to compare as much apples to apples as I can. So some people have, let's say, liquidity needs. They go and search out cards. So what I want to do is I want to make sure that people who got a new card recently, I'm comparing to somebody very similar. How am I going to do this? I'm going to say, since I have data from 2016 as well, these people will open a card or do open a card right after that September of 2015. So these are people who haven't yet opened the card when I see their credit limit on an existing card in 2015, but they will do so in the coming months. So these people have basically the same liquidity needs, roughly speaking, as these people. So everybody on this, in this graph opened the new card between January 2015 and I think it's like April of 2016. And but I only see their credit limits in September. So that's why I'm using that's why it's a little bit awkward. But people who have already had their new card show up on their credit record, so that's why there's like a 1 month delay. It doesn't jump at 0, it jumps at 1. It takes a month for the new card to show up on the credit record and for your lender to respond. All right.
Two questions. One clarifying. So how the banks get the information about the card? Is it like the monitors, they have to incur some cost of monitoring, or is it automatically they have that?
And the second?
And so the second is more like comment. So don't you worry here, so this is unconditional jump, right? So this is just increase. So don't you worry that like banks have some amount of limit in mind, and those who established already have very close to this limit, and therefore the jump is very tiny. But those who just knew, they're like, oh, okay, they have $100 so far, and the bank has in mind like 1,000.
So let me, first question was, do banks actively monitor this? Do they automatically get notified when you open a new card? No, they do have to do this somewhat actively. I'm surprised there is such a discrete jump, because frankly, I thought they would have paid attention like every 3 months. No, this is really immediate. So I'm guessing that when it comes to very new borrowers, they pay attention a lot more than... generally, the banks seem to pay attention, judging by how often they adjust credit limits, they pay a lot of attention in the first 12 months of a product. The second question was, do the established borrowers see smaller jumps simply because they're already close to their like true borrowing limit? That's possibly. So my biggest thing is not, it's kind of, I don't want to compare the sizes of jumps, but it's also, these are, in terms of dollars, this jump might be just as big, because these guys have much, much, much larger, I mean, I'm not going to show it to you, but in terms of relative magnitudes of credit limits, these are 10 times those. Typical credit limit total of an established borrower, 20,000. Typical credit limit of an emerging borrower, 2,000.
No, I think like this graph looks cool, but I think like for established it's way more convincing. Like, you know, the fact that you see it for established, it's already...
Yeah.
Of the convincing of the math.
I understand. I understand. Some of the other things will... I'm happy that you're happy. So let me take that as given and now write down a very, in the nicest way possible, dinky model, meaning I'm going to write out the most stripped down model I can to capture this story. All right? So let's get into it. How am I doing on time? All right. This is going to go fast. What is the absolute minimum I need? I need borrower, I need at least 2 lenders, because I need dispersed information. I need time to build credit history, but doesn't mean I want to deal with multi-period thing. So I'm going to cheat. I'm going to say there are 2 periods. There's only one. There's a borrowing period and repayment period. Since I want a credit history building within the borrowing period, I'm going to break up borrowing period into 2 stages. So the whole idea is there's no consumption between stages. I'm just going to give you a chance to build credit history. Second period is going to be tremendously boring. All the action is going to happen in the first period, and first period is broken up into 2 stages with no repayment in between. This looks like a terribly busy slide. Borrowers, I'm going to make borrowers as boring as I possibly can. So what do I need from borrowers? I need from borrowers for them to be risky and heterogeneous, so that there is something to learn. So how am I going to generate... and I'm going to make them hungry so that they actually want to borrow. So how am I going to make them risky? I'm going to say, well, they have uncertain endowment in the second period when they're going to repay. So some of them will repay, some of them won't. And there are 2 different underlying, I'm going to call them states. We ran out of words. Good and bad, G and B. Good borrowers are more likely to have, good borrowers are more likely to have high realization of endowment tomorrow. That's what we're going to be learning about. That's what everybody in this economy is going to be, in this game is going to be learning about, those 2 underlying states. What else? The borrowers exposed, if their income is too low, they're just not going to repay their debts. And if they don't repay their debts, the lenders don't get paid back. There is no partial recovery. And we're going to make very simple assumptions so that it's very clear what the possible... There are only 3 possible realizations of endowment, low, medium, and high, which means there are 3 possible natural loan sizes. Phi times AL, that's small loan, phi times AM, that's medium-sized loan, and phi times AH is the largest loan possible that could ever be repaid. Is that it? That's it. Borrowers could potentially be risk-averse and patient, but that gets really annoying even in a simple model, so we're going to shut it down. Illustrative example is going to have borrowers who really hungry and don't really care about risk. All right, so all of the action is going to be on the lender side. Even the information, I'm going to, as I said, it's important for me that we're aggregating information across lenders. I'm going to endow all of the information into lenders. Borrowers don't know anything. They're going to learn from the lenders. Okay, so lenders have information and lenders are going to make loans. What information do they have? Lenders get, sorry, first of all, I really want to have two lenders, but if I literally have two lenders, one of them becomes a monopolist once they learn information. I don't want to deal with that. So I'm going to clone my lenders. I'm going to have like purple lenders on this side of the room, yellow lenders on the other side of the room. I'm going to forget those colors later. All of the purple lenders get one signal. All of the yellow lenders get another signal. So that you all yellow people are competing amongst yourselves, as do the purple people. You don't see each other's signals. You all know that every purple person has the same signal, but you don't know what the yellow signal is. The only way we're going to aggregate information is you're going to get to see who I got a loan from and what loan I got in the first stage. So there is this technology of public record keeping where you get to see my loans from stage one. And I'm now a slide ahead of myself. What did I forget to tell you about the borrowers? Sorry, the lenders, nothing else. Lenders are perfect, otherwise lenders are perfectly standard, they're risk neutral, they have access to exogenous risk-free rate. So that's where I was. I gotta start looking at the screen. Right. So first stage, all lenders know their own signals. They make offers. What are offers? It's the loan size and the loan price. So X is how much I promised to repay. Q is per unit price of that. So if I take a loan from you, I take QX today and I promise to pay X tomorrow. What goes into the credit record? The entire thing. How much I borrowed, at what price, and from whom. Frankly, is that what I see on the credit record? No, not quite. But it makes my life in the model a hell of a lot easier if I can just record everything and then I don't have to worry about me coming to Lev and go, hey, Lev, why don't I give you a couple of bucks so that you pretend to give me a loan so that those yellow people think you like me. So let's just rule that out. I'm going to see the prices. I'm going to see what color lender the loan came from. All right. Second period, as I said, is boring. We realize my endowment and we realize whether I pay my loan back or not. Just a quick note. The reason I'm calling this actions is this is a game. So it's not an economy, it's a game. With that in mind, these are payoffs in the game. Nothing unusual here. Really all I care about as a borrower is how much I get to consume today, which is how much I borrowed in the first stage plus how much I borrowed in the second stage. Tomorrow I make a rational decision whether to repay or not. Lenders just care about profits, expected profits. All right. We already talked about the kind of three natural loan sizes. In fact, increasing the loan, any loan below 5EL is risk-free. Any loans in this interval between 5EL and 5M have exactly the same probability of repayment. So we're not going to ever end up anywhere in between. We're just going to end up with one of three possible loan sizes at every stage. So we're just going to restrict attention to that. All right. You don't need my notation. I do need to spend a minute on this. This is a game with both signaling and screening, which means, well, by the virtue of this being a game with signaling, it has gazillion equilibria. So I have to employ some selection criterion. What we really wanted to do is employ Kovrijnykh's intuitive criterion because it's the natural thing to do. This game has a few too many stages for Kovrijnykh's to apply directly, so we're just going to basically modify. We called it intuitive-ish for a while, but that didn't stick. So we're just going to basically pick an equilibrium, very much in the spirit of Kovrijnykh's. It's the equilibrium that's most preferred by the best type. Type. The reason I called there was this underlying state of the borrower, G or B, good or bad. Nobody knows that state. So I'm not going to even talk about it anymore. The relevant type of the borrower in the game are the signals. So there are borrowers who are AA. They have A from the purple, A from the yellow. Those are our best borrowers. That's the best type. There are ABs and there are BBs. So oops. The equilibrium concept, as I said, in the spirit of Cho and Crafts, or in the spirit of Miyazaki-Wilson allocation, it's the equilibrium most preferred by the best type. So it's the equilibrium that's it's the perfect Bayesian equilibrium that's most preferred by the AA borrowers, and turns out the off-equilibrium path beliefs you need to support that are indeed very intuitive. So, all right. I have 13 minutes? Oh, I'm doing fine. So, what does credit history look like in this model? Well, credit history is, step back, in all of the intuitive-ish equilibria of this model, the only way we get any action in stage one is if a positively informed lenders, A lenders, make an offer. Why? Because generally, making a loan in the first stage is a bad idea. Because there's a second stage and somebody else is going to come around and top up the borrower with another loan, which means you're going to get diluted. And now, as a lender, you have to price it in, which means you can't really offer a very good price. So lending in the first stage is not a natural thing in this environment, except for to aggregate information. So what's going to happen is, if A lenders offer a loan in the first stage, I as a borrower may take it with the sole reason to convince the other lenders that you guys had good information about me. So I'm decided purple people are going to be, you guys have a signal about me. Now, first of all, when I woke up this morning, I didn't know what type I was. What do I know? I'm a borrower. I have no experience. You guys are lenders. You know what my probability of repayment is. The way I learn is I learn from your offers. If I wake up, I see all these offers from purple lenders and go, okay, purple people have a positive signal about me. They're A. If I see no yellow offers, they don't have a good signal about me. I now learned that I am an AB borrower. Okay. Now, if all of you guys have good signals, I learn I'm the best type. Now, it makes sense for me to take an offer from one of you to convince the other one that I am indeed AA. Okay? And that's what I'm going to call credit history building. No, I'm not going to have it. Let me leave this on for a second. In a bunch of our equilibria, not always, AB borrowers will also take a first stage loan. AB borrowers are not going to convince, so you guys have A signal, they have B signal. If I take a loan from you, they still think I'm AB. I haven't convinced them all that good. I could just stick with you guys, your A's, even if you presume the worst case scenario that those guys are B's, you're still going to give me an AB loan. You're happy to give me an AB loan. So as an AB borrower, I don't do credit history building, but I may still take a first stage loan. Why? Because it might be at a good price. When is that at a good price? If AA borrower is so high quality that even with that dilution, there's still a better risk than AB, it might make sense for AB to go, hey, I'm not going to convince them that I'm AA, but the offer you're making in the first stage, you don't know who you're making it to. It's this weighted average of AA borrowers and AB borrowers. And if AA price or probability of repayment is better than AB price, then ABs will take it just because it's priced well. So there's maybe this cross-subsidization equilibrium. There are equilibria with cross-subsidization, there are equilibria without cross-subsidization. Enough said, hopefully. Right. I'm again one slide ahead of myself. This slide is telling you that AAs borrow to build credit history. ABs borrow to free ride on AAs building credit history. All right? There's a cost associated. So cross-subsidization may look like a cost of credit history building. It kind of is exposed. Ex ante, it's not. There is an ex ante cost of credit history building, which is in order to build credit history, I take out a first stage loan. I can't commit myself to not dilute it too much tomorrow. So what sometimes happens in this model is over borrowing, what I call excessive borrowing.
Since you asked to interrupt me,
Please do.
Realistically, is information about borrowers in the first stage is default rate, right?
No, no,
Which you don't have.
no, no. This is, again, sorry, the question was, the information that's available to lenders is information about default. Let's go back to my first slide. That's the traditional view of credit history. It's there. When it comes to emerging borrowers, the history isn't long enough. What we're offering is a complement. In fact, I am purposefully shutting that entirely down. There is no chance to repay yet in the model. I'm giving you a complementary story about credit history. So I agree, I'm not questioning for a second that credit history is largely a history of repayment. But in the early stage, it's also a history of borrowing, of taking on loans. And that's, so I'm purposefully shutting down the repayment part and focusing on the borrowing part, on information aggregation. All right. All right, let me not spend too much time on this, because I'm down to 7. It's possible that since I can't stop myself from diluting too much in the second stage, this taking on loan in the first stage actually, I wish I could stop myself. I wish I could promise you purple guys that I'm only going to top up to a medium-sized loan in the second stage, because that's what I should do. I can't, I don't have that commitment. I'm going to overborrow. Of course, guess what? You're going to price it in. I'm going to get screwed. Because of that, sometimes in a very narrow set of parameter values, very narrow, in a narrow set of parameter values, AA borrowers don't want to build credit history. And they just, in that space of, in that portion of the parameter set, we just sit on our hands in the first stage, and then all of the borrowing happens in the second stage without credit history building. Related to that, this is a very nerdy slide, and then we're going to get to work. This is for theorists in the room. For theorists in the room. Sorry, I'm kidding. Having ability to aggregate information, having this mechanism of credit history building, having credit rating agents, sorry, having credit reporting agencies could be welfare reducing. Because instead of sitting on our hands and not building credit histories, we're going to build credit histories and overborrow. And AA's preferred equilibrium is not necessarily social planners' preferred equilibrium. So that's part one. The second, even nerdier point, is increasing the quality of information may backfire. There's like this small region where increasing quality of information actually leads us to start building credit histories and destroys welfare. All right, that was the nerdy stuff. Now, I promised you testable implications that are not obvious ex ante. Let's talk about my purple people who I borrowed from in the first stage. I borrowed from you in the first stage. You know you're going to get diluted. Just, there's no, in the model, there's no doubt, because there's second stage. If I borrowed in the first stage, I'm going to top up in the second stage. The question is, would you rather see me diluted a lot or diluted a little? Now, standard kind of conventional wisdom is the less the better. Because for any given type of borrower, the less I borrow, the more likely we are to be repaid. Except in my model, only the best me's are going to get the largest top-up. So there's the first thing is that was the dilution effect. For any given borrower, the larger the loan, the lower the probability of repayment. But there is a selection effect. Only the very best borrowers are going to get the largest top-up. In the model, quite literally, you purple borrowers who gave me a loan in the first stage, you would rather see a large top-up, not a small top-up. So we call it more dilution is better, or more dilution is, yeah, we call it more dilution is better. We can actually check that in the data. And I, frankly, when my co-author said, hey, let's run that regression, I'm like, oh, there's no way. That's just too good to be true. It's there. And It's there only for emerging borrowers. Now, in the model, you knew you were stage 1. You knew I was going to get diluted. In reality, you don't know that. So that's where things get really interesting. In reality, the fact that I take on a new loan is bad news. The fact that I open a new card, sorry, what am I, on the left-hand side is probability of delinquency. It's called probability of default. The fact that I took out a new loan, bad news. But the larger the new loan, the not so better the, that did not work. The larger the loan, the less the damage. And it's not there for established borrowers. So that's it. That was my shockingly, I seriously, I did not expect that to hold up in the data. Katya just told me I have whole of 3 minutes. Very quickly, credit history is not equal to credit score. The worst borrowers, BBs, are safest because they're so bad nobody gives them a loan. As a result, they don't have high probability of default. Credit score is the reflection of probability of default. So in this model is a very nice illustration that building credit history doesn't necessarily mean improving your credit score. You might lower your credit score, but that's because you might increase your probability of default. But what we call credit history building is improving lenders' perception of your underlying type. So in my model, people are really hungry. So the guys who end up with the largest loans are the best borrowers. They also will end up sometimes with the highest probability of default. So there's a kind of radical distinction between a credit score and a type score and building credit history. All right. So I don't need to summarize this anymore, I don't think. What we are offering is a complementary view of credit history as that of aggregating the actual borrowing behavior as opposed to just repayment behavior. And we think that for at very early stage of a credit life cycle, that's an important force. And it seems to be there in the data. All right. With 1 minute to spare.
Let's use this one moment for questions and yeah.
Well, I don't have the finished story, but I'll at least start the story. So you have like 2 types of borrowers in your model, bad ones and good ones. 3 types. Well,
keep going.
Yeah. So, but for the credit card company, there are, well, let's go 3 types of borrowers. One type of borrower is a person who gets credit card. He or she wants to build this history, but they don't actually take payable loan. So for most of cards, there is like this 100 days you don't pay and stuff. So people take this loan, they repay it without any interest, and they just want to build history or whatever. They are also not interesting clients for banks. And the people who take loans and never pay them back, they are bad, of course, type. But this first type is also bad for bank. So the most interesting type for bank is a person who takes a loan, but then like for more than 100 days, but pays back with interest. So whenever person just gets first credit cards, it is not clear if this person will be first type or second or third. Maybe this, so now here I didn't finish the story.
How many minutes does he have?
Yeah, so maybe this like getting new card signals something about, so that helps banks to distinguish between the first and the second type, for example.
I love where you're going with this. We even have names for that, and turns out, so they're called revolvers and transactors. Transactors are people who just, so let's be clear. In the model, there's no distinction between a credit line and the balance. A loan is a loan. And yet in the data, I was looking at credit cards and I was using credit limits as opposed to balances. Which, by the way, means that, so in the model, you kind of, there's this cross-subsidization because I'm paying the interest. In reality, if I just took a credit card
it's not
and I didn't pay the interest, then I did cross-subsidizing. Absolutely. Now, let's get back to your question, because I think it's actually a very interesting one, even though not necessarily related directly to that. Transactors are people who just charge every month and repay their balance in full. They never pay interest. You call them uninteresting to a credit card company. Guess what? Credit card company makes a ton of money on the interchange fees. So they're actually also good customers. In fact, that's me. And that's why they keep increasing my credit limit to make sure I have enough credit limit to keep spending. So there are transactors who are good customers. There are revolvers and repayers who are good customers, and there are revolvers who don't repay. Those are bad customers. So in a way, the model is that of revolvers. There's very little work done on kind of figuring out who is more profitable, revolvers or transactors, and there is no kind of revolver score.
Still, revolvers should be more profitable for bank than just transactions, because they're doing both transactions and also pay interest.
But they have something to default on if things go bad. So it gets a little tricky. Also amongst, anyways, we'll take that offline because I think I'm out of time and I don't want to stand in the way of lunch.
Okay.
Thank you.